Welcome back to Fair Fade Investing. Today we're taking a look at VF Corp, ticker symbol VFC. We've got price per share of $15.20, market cap of $5.91 billion, and an enterprise value of $13.33 billion. First thing I'm noticing is the enterprise value consists of over double what the current market cap is. The enterprise value represents a deeper alternative valuation to market cap that consists of the market cap, short and long-term debt, as well as any cash or cash equivalents on the balance sheet. Moving into the financials and profitability, right away the first thing I'm noticing, cash to debt ratio of 0.06, so a very low amount of cash on hand in relation to the debt. When we look at the profitability, we've got gross margins, operating, net, and free cash flow margins. We do see a strong green bar here for the gross margin versus the industry. So with 52.5 gross margin versus the industry, they're on the better end. Although that's sort of the only highlight that I'm seeing here. Versus history, they're right around their median for the last 10 years. When it comes to operating margins, well below their median. Now, when we see net margins, their net is actually negative right now, and their free cash flow is also negative. So the net margins are the total profit after all expenses. So we do see that they are losing money, including all their expenses. And for free cash flow, or the percent of revenue that is left for expansion, dividends, or reducing debts after expenses, they're still negative. So hard to say where it could be headed from here. We do see history, a lot of red. We do see a lot of red and yellows here in the history column versus the industry. The only thing that they're doing well compared to their industry is gross margins. When we look here at the description, we see that VF Corp designs, produces, and distributes branded apparel, footwear, and accessories. Its apparel categories are active, outdoor, and work. Its portfolio of about a dozen brands includes Vans, North Face, Timberland, Supreme, and Dickies. VF markets in Americas, Europe, Asia, and wholesales to retailers, e-commerce, and branded stores owned by the company and partners. The company has grown through multiple acquisitions and traces its roots to 1899. When we look at the revenue for the trailing 12-month period, we have $11.39 billion of revenue versus their current $5.9 billion market cap. So the company itself is trading for just about half their trailing 12-month revenue. Another thing that's interesting to look at here is the revenue over time, as well as net income and EBITDA. We do see that over time, the revenue was increasing through 2022, and since then it's fairly flat, maybe even marginally decreasing. But when it comes to the net income, it has dropped off significantly. With the cash to debt, we see that back in 2020 they had just about half of their debt in cash, whereas now they have substantially more debt than they have cash. Net income dramatically drops off here. We see operating cash flow go into the negatives. We see dividends decreasing as new management came in, which is maybe not a bad sign for a business that wants to turn around. We see free cash flow in the positive here, and then dipping into the negative in late 2022, and still negative here in the current. We see there was share buybacks in 2020, share sales in 2021, share buybacks in 2022, and now some share sales. To gain further insight into where the company could be headed in the future and what's currently priced in, let's run a DCF. So first thing here in the DCF, we see that the business is fairly unpredictable. And we do see that on earnings per share value and free cash flow, there's minimal data available to base judgment off of. So we do see the deceleration here in the last 3 years for earnings per share. So an annual decrease of about 9% per year. Definitely not what you want to see, although new management could be doing things, and I do believe is doing things to redirect the ship. But anyways, let's just see what a hypothetical framework could be here. See what's currently priced in to start. So it looks like currently there's about negative 1% growth over the next 10 years priced in. So how I interpret that is a company is currently valued to decrease at 1% every year for the next 10 years. They do have new management in. The new CEO is known to have turned around multiple companies. So obviously if they are to grow at even a small amount over the next 10 years, then their fair value would be considerably higher than it is today. 5% growth for earnings per share over the next 10 years equates to a fair value of 22.6, where we're currently at 15. Obviously, we go higher, we get an even further fair value. And if they were to continue their losing streak, well, eventually they'd go out of business. But if they were to do exactly what they've done for the last 3 years for the next 10, then the fair value would be closer to 961, whereas we're currently at 15.2. This is my theoretical framework and assessment of VFC. Leave a comment below if you have questions or want a company reviewed. If you enjoyed the video, please leave a like, subscribe, and I'll see you next time.